Basics of Investing. Chapter 14, Continuous Improvement and Journaling. Section 1, Journal Structure. A journal is not just a place to store results. Its real value is that it helps you study the quality of your decisions, including what you saw, what you planned, and how you acted. If you use the same structure every time, you can compare trades fairly instead of relying on memory. That consistency makes patterns easier to spot, such as entering too early, sizing too large, or following one setup well and another poorly. It also makes review more honest, because each trade has to answer the same questions. The goal is not to create a diary. The goal is to build a record you can learn from. A strong journal usually has 3 separate layers, and each one does a different job. The first layer is the trade record, which captures what actually happened in plain facts. The second is the decision log, where you record why you entered, what the plan was, and what changed while the trade was open. The third is reflection, where you briefly note what to repeat and what to improve after the trade is finished. Keeping these layers separate matters because facts, reasoning, and hindsight can easily get mixed together. When they stay distinct, later analysis becomes much clearer. The trade record is your factual foundation. It should include the objective details of the trade, such as date, time, instrument, direction, entry, exit, size, stop loss, and the amount of money or risk involved. You can also include measures like profit or loss and the R multiple, which shows the result relative to the amount risked. The important part is that this layer stays free of opinions and emotions. No comments like, "I felt nervous," or "this was a bad idea," belong here. Clean factual records are what make your metrics trustworthy later. The decision log captures your thinking at the time of the trade. This is where you record why you entered, what setup you believed you were seeing, where the stop and target were supposed to be, and what would make the trade invalid. If you changed the trade while it was open, that belongs here too, along with the reason for the change. For example, if you moved a stop because volatility expanded, write that down clearly. If you trimmed size because market conditions shifted, record that as well. This layer helps you judge execution fairly, because it preserves the plan before memory starts rewriting the story. Reflection belongs after the trade is closed, and it works best when it is short and structured. A useful reflection might name one thing you did well, one thing to improve, and any rule you clearly broke. Keeping it to just a couple of sentences forces you to stay specific instead of turning the entry into a long story. For example, you might write that you followed your entry criteria well, but your exit planning was late. If you broke a rule, say exactly what it was instead of hiding behind vague language. Short, direct reflections are much easier to review across many trades. Structure is what makes journaling useful beyond a single trade. When every entry follows the same format, you can compare similar trades much more easily and see what repeats. That is how recurring mistakes begin to stand out, such as late entries, poor sizing, or inconsistent stop placement. Consistency also helps you separate strategy problems from execution problems. A strategy may be sound while your discipline is weak, or your discipline may be fine while the setup itself is underperforming. Without structure, those differences blur together and the review becomes unreliable. The best time to build your template is before you need it. If you decide on the fields in advance, logging becomes fast and repeatable instead of something you improvise after each trade. Use the same fixed fields every time, and include short prompts for the original plan, any adjustments made, and a brief reflection. The template does not need to be elaborate. In fact, simpler is usually better, because you are more likely to use it consistently. A good test is whether you can complete most of the entry in about a minute. A journal only helps if the information in it is trustworthy. That is why it is best to log the trade promptly, ideally within a few minutes of closing it, while the details are still fresh. Delayed logging increases the chance that you forget key facts or quietly reshape the story around the result. If you ever do need to correct an entry, make the correction transparent and include a timestamp. That way, the journal remains an honest record rather than a revised version of events. Protecting the integrity of the data is what makes later review meaningful. Putting the 3 layers together makes the process feel simple and practical. Imagine one entry that starts with the factual record, a Euro/USD long that made $74 or won 48R. Then the decision log explains the setup, perhaps a breakout followed by a retest with a planned target already defined. Finally, the reflection adds a short lesson, such as following the setup well, but needing to improve the sizing process. Each layer answers a different question: what happened, why you took it, and what to improve. That separation is what turns one trade into a useful learning example. Most journaling mistakes come from mixing categories or abandoning consistency. One common problem is treating emotions as if they were hard data instead of recording the actual behavior they caused. Another is editing past entries without noting the change, which weakens the integrity of the record. Traders also create problems when they change the field order, skip fields, or write long, vague diary entries that are hard to review later. A lean structure solves most of this. If the journal stays specific, repeatable, and honest, it becomes much easier to learn from. For your next trade, think in terms of the same 3 parts every time. Start with objective data only, then capture the decisions as they happened, and finish with 2 short reflection sentences after the trade is closed. That simple routine is enough to create a much better learning record than most traders keep. You do not need a perfect system on day 1. You just need a structure you can follow consistently. Then, during your weekly review, you can refine the template if a field is missing or unclear. That is how the journal becomes a tool for better future decisions, not just a record of the past. Section 2. Metrics. Once the journal structure is in place, metrics give you a way to learn from it at scale. They turn a list of trades into evidence about what is actually helping or hurting performance. Instead of relying on memory, you begin to see patterns in outcomes, execution, and risk. Metrics can show whether your edge is improving, drifting, or being undermined by behavior. They are especially useful because they help separate feeling from fact. The key is to keep them focused on numbers that genuinely support better decisions. Not every number is equally useful. Some metrics have high leverage because they help explain why results are happening and what might improve them. Measures like risk-reward ratio or expectancy tell you much more about your process than a raw profit number by itself. A large total profit can look impressive while still hiding poor discipline, oversized risk, or lucky short-term results. That is why it helps to ask a simple question: does this metric help me make the next decision better? If the answer is no, it may be more of a vanity metric than a learning tool. It helps to separate metrics into 2 groups: outcome metrics and process metrics. Outcome metrics tell you what happened, such as win rate, average gain, average loss, or total profit and loss. Process metrics tell you how you traded, including whether you followed rules, how long you held positions, how often you traded, or whether your sizing stayed consistent. Outcomes matter, but they are backward-looking. Process matters because it often drives those outcomes over time. Good short-term results can come from bad habits, so this distinction keeps your view grounded. There are a few core outcome metrics every trader should understand. Win rate tells you the percentage of trades that were profitable. Average win and average loss show how large your winners and losers tend to be. Risk-reward ratio compares those 2 numbers, and total profit or loss gives the net result over a period. Each metric answers a slightly different question, so none of them should be used alone. Together, they create a more complete picture of performance after the trades are finished. Expectancy is one of the most important metrics because it combines both how often you win and how much you win or lose when you do. In simple terms, it estimates the average amount your strategy makes or loses per trade over many trades. The formula is win rate times average win minus loss rate times average loss. If that number is positive, the strategy may have an edge. If it is negative, something needs attention, whether that is the setup, the execution, or the risk control. Expectancy is powerful because it summarizes the long-run economics of the strategy, not just one appealing statistic. Win rate by itself can be very misleading. A strategy can win often, but still lose money overall if the losing trades are much larger than the winners. On the other hand, a strategy with a lower win rate can still be profitable if its winners are meaningfully larger than its losers. That is why traders sometimes become attached to a high win rate even when the math is working against them. The size of wins and losses matters just as much as frequency. Reading metrics together gives a much truer picture than focusing on one number in isolation. Early metrics can move around a lot, so small samples need caution. A handful of trades may produce numbers that look impressive or alarming, but much of that can just be noise. That is why early results should be treated as preliminary rather than definitive. As a rough guide, conclusions become more useful after something like 30 to 50 trades, depending on the strategy. Honest recording also matters here, because the sample is only meaningful if it includes every trade, not just the ones you feel like remembering. Leaving out losers creates survivorship bias and makes the metrics less trustworthy. A simple tracking system is usually enough to start. Pick 3 to 5 core metrics, such as win rate, risk-reward, expectancy, and trades per week, and calculate them from the same journal fields every time. A spreadsheet works well, and many journaling apps can do the same job if you prefer automation. The important thing is that the journal captures the inputs consistently: date, instrument, entry and exit prices, amount risked, profit or loss, and whether you followed the plan. From there, the numbers become much easier to update and review. Consistency matters more than complexity. Reviewing metrics well means reducing noise instead of reacting to every fluctuation. Update your journal after each trade, but analyze the numbers in batches so small swings do not dominate your thinking. Reviewing every 20 trades, for example, often gives a clearer picture than checking after every single result. It also helps to compare the metrics with your process notes because numbers alone cannot always explain the cause. Use an early sample, such as your first 50 trades, as a baseline for comparison. And when averages are distorted by outliers, check the median too, so one unusually large trade does not tell the whole story. This is where metrics can protect you from abandoning a strategy too quickly. Imagine that your win rate drops from 55% to 45%. At first glance, that looks like deterioration, but if your average loss shrinks meaningfully while your average win stays strong, expectancy can remain positive. In that case, the strategy may still be working, just in a slightly different way. The lesson is that a lower win rate is not automatically a sign that the edge is gone. What matters is the combined relationship between frequency, payoff, and risk control. A short calculation exercise helps make these ideas concrete. If a sample has a 50% win rate, an average win of $260, and an average loss of $150, the risk-reward ratio is about 1.73, and expectancy is $55 per trade. Those are useful numbers, but interpretation still matters. With only 10 trades, the sample is small, so you would treat the conclusion as tentative. This is also a good reminder not to track too many metrics at once or mix different strategies together. The numbers help most when the sample is honest, the categories are clean, and the conclusions stay appropriately modest. Section 3. Reviews. A review is where the journal starts becoming feedback. It is more than a recap of what happened, because it asks why the result occurred and what that means for future decisions. A good review tries to explain performance rather than just describe it. That means looking for causes, checking whether expectations were reasonable, and deciding whether anything should change. In other words, the review turns records into lessons. Without that step, journaling can stay informative but never become corrective. It helps to distinguish between a trade log entry and a review. A trade log entry records one trade with its details, plan, and outcome. A review steps back from individual trades and interprets them as a group. The log captures information. The review looks for patterns in behavior and strategy. For example, one trade might show a late entry, but a review might show that late entries happen repeatedly on one setup type. That broader view is what makes the review more analytical than the log itself. At the heart of every strong review is a 4-part comparison. What was the plan? What did you actually do? What did you expect? And what actually happened? Comparing plan to execution helps you see discipline and process errors. Comparing expectation to outcome helps you judge the quality of the idea itself. Those are two different kinds of problems, and they need different responses. A trade can fail because the setup was weak, or because the setup was fine and the execution was not. Reviews become much more useful when you focus on those gaps instead of just the profit or loss. 3 questions can keep the review process disciplined. First, did I follow my plan? If the answer is no, The issue is probably execution before anything else. Second, if I did follow the plan, was the plan itself valid under those conditions? That helps you test the setup rather than blaming yourself automatically. Third, what should change, if anything? This last question matters because not every loss requires a change, and not every win confirms that the system is sound. These questions help prevent random adjustments after a small number of trades. Reviews work best when they are scheduled and done with some emotional distance. Weekly reviews are often a good rhythm because they are frequent enough to catch patterns, but not so frequent that every small swing feels important. Reviewing too soon can lead to reactive thinking, especially if trades are still open or emotions are still elevated. Reviewing too rarely creates a different problem, where memory fades and patterns stay hidden longer than they should. Completed trades make the cleanest material for review. The goal is a calm cadence that supports learning rather than judgment. A simple review process is usually enough. Gather a batch of completed trades, sort them into winners, losers, and scratches, and then compare each one to its original plan. As you go, look for clusters rather than one-off events. Maybe several losses came from the same setup, or maybe the problem was not the setup at all, but repeated early entries late in the day. After you spot the main pattern, write one actionable conclusion. That last step matters because a review without a clear conclusion often turns into observation without improvement. Patterns become useful when they lead to a testable next step. Suppose you review 4 trades and notice that 2 winners and 2 losers do not tell you much by themselves. But then you see that one losing trade came from a weak thesis, another came from breaking the plan, and both losses shared the same feature, entering too early. That repeated detail is more important than the simple win-loss count. A practical conclusion might be to require one extra confirmation before entry. That turns the review from a description of the past into a rule you can test in the future. Several habits can make reviews much less useful. One is reviewing only losing trades, which ignores whether winning trades were actually well executed. Another is rewriting history after the fact because hindsight makes bad analysis feel neat and convincing. Traders also get into trouble by changing rules based on a single trade or by reviewing while still emotional. And if the review ends without a written conclusion, it often produces no clear improvement. Honest, consistent reviews need both emotional distance and a final decision. A simple way to build a review habit is to use your last 5 completed trades. For each one, mark whether you followed the plan or not. If you did not, name the exact broken rule instead of using vague language. If you did follow the plan, then judge the thesis by what price action actually did. After that, write one sentence about what to keep or what to change. This small routine creates a repeatable bridge between journaling and better decisions. Section 4. Mistakes. When thinking about mistakes, the most important distinction is between outcome and process. A losing trade is not automatically a mistake if it followed a sound plan and respected the rules. In the same way, a winning trade is not automatically good execution if it involved rule-breaking or reckless decisions. A true mistake is a process failure, something that breaks your plan, your risk rules, or your discipline. This distinction matters because improvement comes from correcting errors in decision-making, not from trying to eliminate every loss. Judge the trade by process first, and let the result come second. This distinction matters because results can easily teach the wrong lesson. Good process can lose money in the short run, and bad process can make money for a while. If you praise every winner and criticize every loser, you can accidentally strengthen bad habits and weaken good ones. Over time, that makes performance less stable, not more. Process errors often show up before profit and loss problems become obvious. That is why reviewing rule violations early can be more valuable than reacting to the P&L alone. Most mistakes fall into 3 broad categories. Planning mistakes happen before the trade, such as weak preparation, poor sizing, or taking a setup that never truly qualified. Execution mistakes happen during the trade, like chasing price, moving stops, or exiting impulsively. Psychological mistakes are driven by internal pressure, such as fear, revenge, boredom, or overconfidence, and they often show up through visible actions. Sometimes more than one category seems to apply, but it helps to choose the root cause. Clear labels make repeated patterns easier to identify and fix. Planning errors begin before any order is placed. These are often the result of rushing, weak preparation, or assuming you already know enough without checking. Common examples include skipping support and resistance analysis, miscalculating position size, entering without a defined stop, or taking a setup that does not fully meet your rules. These mistakes can feel small in the moment because nothing dramatic has happened yet, but they often create problems that show up later as larger losses or unnecessary stress. Strong pre-trade discipline prevents many mistakes before they start. Execution and psychological errors often happen close together, because emotions tend to show up through trading actions. Execution errors include hesitating and missing a valid entry, widening a stop after the trade moves against you, or taking profits too early without a rule-based reason. Psychological errors are the forces underneath those actions, such as fear of missing out, revenge after a loss, boredom, or overconfidence after a winning streak. In practice, the emotional trigger may be internal, but the journal should still capture the visible behavior. That makes the mistake easier to review and easier to correct. Under pressure, discipline usually breaks in specific, repeatable ways. When you record mistakes, be concrete. Vague notes like bad trade do almost nothing to help you improve because they hide the real pattern. A much better entry says what you did, what you should have done, and what emotional state was present. For example, you might write that you bought after price jumped beyond your entry rule, that you should have waited for the planned pullback, and that you felt impatient and slightly overconfident. That level of precision creates useful data. Exact actions reveal patterns that vague labels never will. A short review routine can make mistake tracking much more objective. Start by checking each completed trade against the original plan. If a rule was broken, log the process error rather than focusing only on the result. Then label the root category, such as setup, risk, execution, or psychology, and rate the severity on a simple scale like 1 to 5. This helps you separate minor slips from more serious discipline problems. With repetition, the routine makes mistakes easier to classify and compare across time. The point of reviewing mistakes is not to create guilt. It is to build prevention. Look for repeated behaviors over the course of a week, especially when they appear around the same time of day, after the same trigger, or under the same emotional conditions. Once a repeat pattern is clear, create one preventative rule aimed at that specific problem. For instance, if mistakes cluster after 2 losses in a row, you might stop trading for the rest of the session after that point. The goal is not perfection. The goal is to reduce the frequency of the same mistake happening again. This example shows why the real mistake is not always the loss itself. Mia's original short trade was within her plan, so the initial position was not the problem. The mistake came later when discomfort led her to add to the losing position, even though her rules allowed only one trade that session. That turned a normal planned loss into a larger, avoidable one. The category here is execution because she interfered with the trade and broke a clear rule. The journal should make that distinction obvious. The loss was acceptable, the rule break was not. A better mistake tracking habit is specific, consistent, and neutral. Review winning days as well as losing days, because a profitable session can still contain bad process. Keep reminding yourself that losses are not the same thing as mistakes. When a rule is broken, name it clearly instead of hiding behind general language. And do not focus only on execution, because some problems begin earlier in planning. When the journal stays neutral and concrete, it becomes easier to learn from mistakes without turning the process into self-criticism. Section 5. Iteration. Iteration is what turns all this review work into actual improvement. The journal records decisions, the review reveals patterns, and iteration tests one focused change based on that evidence. Without iteration, insight can remain interesting but passive. With iteration, you begin to ask practical questions like, what happens if I tighten one rule, delay one type of entry, or reduce size in one market condition? The point is not to change constantly. The point is to make deliberate changes that can be observed and evaluated. At its core, iteration is simple. You change one variable, measure a defined outcome, learn from the result, and repeat with discipline. The key phrase is one variable, because that is what makes the lesson interpretable. If you change position size, entry timing, and exit logic all at once, you may see a different result but have no idea why it changed. A controlled adjustment gives you cleaner evidence. Over time, this creates a much more thoughtful path to improvement than random experimentation. Random tweaking feels productive, but it usually creates confusion. If several rules change at once, the result becomes blurry because you cannot tell which change helped or hurt. One week you might trade smaller, take fewer setups, and use tighter stops, and then assume the final outcome proves something. In reality, the causes are mixed together. Systematic testing is slower, but it produces clearer lessons. Isolating one variable at a time is what makes the results useful rather than anecdotal. Before you start any test, define what success means. If the goal is vague, it becomes easy to justify weak results afterward, or to call the test a success for the wrong reason. Choose one metric you want to improve, such as average win, average loss, consistency of execution, or win rate. Then set a precise standard, like improving average win by 15%, or reducing average loss below a certain level. Write that goal down before the first trade in the sample. A test becomes much more disciplined when the finish line is clear in advance. A useful test also needs a meaningful sample. Trading results are noisy, so one strong day or one bad week rarely proves much by itself. That is why it helps to judge the test by number of trades rather than calendar time. A sample of 20 to 30 trades is often enough to make the signal clearer, though the right number depends on the strategy. The hardest part is usually patience, because psychology pushes traders to conclude too early. Sticking to the planned sample protects you from reacting to randomness. A practical iteration cycle can be very straightforward. Pick one specific variable to change, define the success metric, run the test for a fixed number of trades, and then review the results. After that, make a decision, keep the change, modify it, or revert to the old rule. This process works because each step is explicit. You are not just trying something and hoping it feels better. You are creating a small experiment with a written question and a measurable answer. Anna's example shows what disciplined iteration looks like. She noticed that late entries were hurting her breakout trades, but instead of rewriting her whole system, she changed only the entry method. For the next 20 qualifying trades, she used the limit order at the breakout level. She defined success in advance by aiming to raise average win by 15%, while making sure trade count did not fall by more than 10%. Everything else stayed the same. That is a clean test, because one problem led to one focused change with a clear standard. The result of Anna's test met the standard she set beforehand. Average win increased from $120 to $145, win rate improved slightly, and trade count dropped from 20 to 18, which still stayed within the allowed range. Because the outcome matched the target, she kept the new entry rule. But the deeper lesson is not just that the numbers improve, it is that she could explain why they improved. The change reduced late entries, and the improvement showed up exactly where she expected to see it. Most iteration mistakes come from weak process discipline rather than lack of effort. A common one is changing multiple variables at once, which makes the result impossible to interpret. Another is stopping the test too early because of a bad streak or a few encouraging trades. Traders also get misled when they judge only by total profit and ignore the quality of the path, such as average loss, consistency, or rule following. And if the outcome is not documented, the lesson is hard to reuse later. Good testing depends on patience, measurement, and record keeping. If you want to build your own test plan, start by reviewing your last 30 trades for a repeated issue or opportunity. Then write the current rule exactly as it exists today, so you know what baseline you are changing from. Define one change to test. Choose the metric that will judge success, and set the sample size before you begin. It also helps to create a journal entry specifically for the test, so you can track the idea cleanly. A written plan keeps the process disciplined when emotions start pulling at it. One thoughtful, measurable change at a time is enough to create real improvement.